Most people have never sat down and read through their balance sheet. And honestly, a lot of business owners aren't even sure what it is. But here's the thing, you already understand exactly how a balance sheet works. You just don't know it yet. Because the same math that explains your car, your mortgage, and your credit cards, that's the balance sheet. And once you see it that way, it starts to make a lot more sense. In this video, I'm going to show you why the balance sheet is the one financial report that never resets and why I consider it the most important document in your business. What the three sections of the balance sheet mean using everyday examples you already understand, and what a strong balance sheet looks like versus one that should have you paying closer attention. But before we get into it, I want you to picture a bowling score, not the score for the frame you are currently in, the running total at the top. That number that doesn't care how well you did in frame 3, it's carrying every strike, every spare, every gutter ball you've thrown since frame 1. Your profit and loss is the frame you're in right now. It shows how you did this month, this quarter, and this year, and then it resets. But your balance sheet, that's the running total. It never resets. It keeps score of everything since the day you opened. So let's talk about what's actually in the running total. Most business owners I talk to are checking their profit and loss every month, maybe looking at revenue, looking at expenses, seeing if the number at the bottom is positive, and that makes sense. The P&L is a great report, but here's what I want you to keep in mind going into this video. That report resets every single year. At the start of each new fiscal year, it starts over, clean slate. The balance sheet doesn't do that. It never resets. And that's a really important distinction. Your profit and loss is telling you how the business performed during a specific window of time, but your balance sheet has been building since the first day you opened. Every account, every dollar carrying forward year after year. So when someone wants to understand the full financial picture of your business, not just how you did last quarter, but how the business is actually doing, the balance sheet is where that story lives. There's a simple formula that runs underneath all of it. Assets equal liabilities plus equity. I know that's accounting speak, so let me translate it. Assets are what the business owns, liabilities are what the business owes, and equity is what's actually yours after you subtract one from the other. And that's it. That's the whole report. In my experience, when lenders or financial professionals are reviewing a business's finances, they tend to pull the balance sheet before they even look at the profit and loss. And the reason for that makes sense once you understand what's in it. A profit and loss can look great on paper and still not tell you whether the business is actually in a healthy financial position. The balance sheet tends to tell that fuller story. So let's break down each section, starting with assets. This is the first section you're going to see on the balance sheet, and it's probably the one that feels the most intuitive. But I want to make sure you're thinking about it in the right way, because a lot of owners I talk to think assets just means money in the bank, and it's bigger than that. Let's use a simple example. Say you bought a work truck for your business. You paid $10,000 down and took out a $40,000 loan for the rest. The truck itself, that's an asset. The loan you used to buy it, we'll get to that in a second. But the truck, the thing you actually own and use in the business, that shows up on your balance sheet as an asset. Same goes for your bank account. The cash sitting in your business checking right now is an asset. If your business is on accrual accounting, money that clients owe you but haven't paid yet shows up as an asset as well. That's called accounts receivable. If your business carries inventory, that's an asset. If you own the building that you operate out of, that's an asset. Equipment is on there as well, though with a caveat. Not every purchase automatically becomes an asset on your balance sheet. Smaller purchases tend to get expensed directly, meaning they hit your P&L instead. It's the large purchases, the ones above whatever capitalization threshold your business uses, that get recorded as assets. So it's not that every supply run or small tool you buy is living on your balance sheet. It's the bigger items, the equipment, the vehicles, the property. Now there are really two buckets of assets, and you don't need to overthink this. The first bucket is things you'll use up or convert into cash within the next year. Cash, money owed to you, inventory. Those are called current assets. The second bucket is things you're holding for longer. The truck, the equipment, the building. Those are your long-term assets. Here's an important shift in thinking for those bigger purchases. When you spend money on a significant piece of equipment, you didn't just lose that money. You moved it. It went from sitting in your cash account to sitting in an asset account. The value didn't disappear, it changed form. And that's a very different way to look at it than just thinking you spent money. So assets are everything the business owns and controls. Cash, receivables, inventory, equipment, vehicles, property, all of it. And it's all sitting right there in that first section of your balance sheet. Now, let's talk about the section that makes a lot of owners a little uncomfortable. Liabilities. Back to that truck. You took out a $40,000 loan to buy it. That loan is now a liability. The balance on your business credit card from last month's orders, liability. These are the ones that people usually expect to see on the balance sheet. Loans, credit cards, lines of credit, those are pretty straightforward. But here's where it gets a little surprising for most people. Liabilities aren't only loans and credit cards. If you have employees, there are payroll taxes being withheld from their paychecks that you may not have sent into the government yet. That money's sitting in your bank account, but it's not yours. It's a liability. Same thing with sales tax. If you're collecting sales tax from customers and you haven't remitted it yet, that balance is a liability. It was never your money to begin with. You were just holding it. And this is honestly one of the most common places I see business owners get into real trouble. They collect sales tax, it lands in their bank account, it looks like available cash, and they spend it. And then the remittance deadline comes. And this is a real situation, and it happens far more frequently than it should. So why does this matter so much? Because liabilities create a kind of quiet pressure that you might not feel just by looking at your bank balance. Your checking account might look fine, but if there are liabilities sitting on your balance sheet that you're not keeping track of, the picture isn't as clear as you think it is. You could feel totally okay and still have a significant financial obligation you haven't accounted for. The balance sheet makes those obligations visible. That's the whole point. You can't manage what you can't see. Okay, so we've got what the business owns and what it owes. Now let's get to the part that actually tells you what's yours. Think about your house for a second. If your home is worth $400,000 and you still owe $300,000 on your mortgage, you've got $100,000 in equity. That's the part that's actually yours. The part that's left after you subtract what you owe from what it's worth. Your business equity works exactly the same way. Take everything the business owns, subtract everything it owes, and what's left is equity. That's your ownership value. That's what's actually yours. So what's actually living in that equity section? A few things. It's going to show the money you initially put into the business to get it started, any additional money you've contributed since then, money you've taken out over time, which depending on how your business is structured, might be called owner's draw or distributions or something similar. And it'll show the accumulated profit that the business has retained since day one. That's called retained earnings, and it's basically just the profit that stayed in the business instead of being paid out. Now, here's a nuance that's worth knowing. Those draw or distribution accounts do live in the equity section, but in my practice, I move them into retained earnings at year end so that the account resets each year. Not every accountant handles it that way, but that's how I do it. So while the balance sheet itself never resets, the equity section does get some housekeeping done on it annually, or at least it should. One more thing on equity that I think is really worth pointing out. The net income from your profit and loss actually pulls into the equity section of your balance sheet. So these two reports aren't completely separate. They talk to each other. Your P&L feeds the balance sheet, which is another reason why it's hard to just look at one and ignore the other. And if your business has partners or investors, the equity section becomes even more important because it's tracking how much each person has put in, how much they've taken out, and what their stake actually looks like right now. It's not a conversation or an assumption. It's right there in the report. So that's the three sections: assets, liabilities, equity. But I want to explain something that I think is going to completely change how you think about the balance sheet overall. When I sit down to review a set of books, I pull the balance sheet before I look at the profit and loss. That's just how I work. And most of the experienced bookkeepers and accountants I know tend to do the same thing. It might seem backwards if you're used to going straight to the profit loss, but there's a reason for it. Balance sheet errors can quietly compound for years. We're talking about things like loans that were never set up correctly, credit cards that were never reconciled, payroll tax balances that don't match what was actually remitted, liabilities that got missed entirely. These things don't announce themselves. They just sit there and they grow. And in my experience, P&L errors tend to be a little easier to catch. You're looking at a single period of time, so something that's off usually stands out. But a balance sheet problem, it can hide for a long time, and the longer it hides, the messier it gets to clean up. Here's a real-world example of what this can look like. A business owner thinks everything is fine. Their profit looks good on the P&L, but when you pull the balance sheet, you find old sales tax liabilities that were never paid, a loan that was set up wrong and showing in the wrong place, or payroll taxes that were never remitted. On the P&L, looks profitable. On the balance sheet, not so much. And that's the thing. The balance sheet doesn't care what your revenue looks like. It's keeping score of everything, which is exactly why when a lender's considering a loan or when someone's thinking about buying or investing in a business, the balance sheet is often one of the first things they want to see. In my experience, it's harder to overlook problems there. This is also why a balance sheet that's been maintained correctly over time is genuinely valuable. It's not just a compliance document, it's a record of how the business has been run since day one. So, what does a healthy balance sheet actually look like? And what are the signs that one needs some attention? A business that's growing in the right direction is generally going to show assets increasing over time, liabilities staying controlled, and equity building. That's the direction you want things moving. More owned, manageable debt, and your stake in the business actually growing. Growth without control can look very different. Debt climbing faster than assets, equity sitting flat or going negative, cash running thin even when revenue's up. And that last one's a really common situation. A business can be pulling in strong revenue and still be in a tight spot financially because revenue isn't the whole picture. Here's something I want you to sit with for a second. A bigger business isn't always a healthier business. In my experience, a $2 million revenue business carrying a lot of debt and weak equity can actually be in a less stable position than a $500,000 revenue business with strong equity and clean, well-maintained books. Revenue is one data point. The balance sheet gives you a much fuller picture, and that's really the mindset shift I'm hoping you take away from this video. The balance sheet isn't just something your bookkeeper maintains so you can hand it over to your CPA at tax time. It's answering real questions about your business. Are you actually building something? Are you overextended? Could your business handle a slow month? If a lender reviewed your books today, what would they see? Those aren't accounting questions, they're business questions. And the balance sheet is where a lot of those answers live. Now that you know how your balance sheet works, there's another foundational piece that directly affects how transactions show up on that report. And it's one of those things that a lot of small business owners didn't realize they had a choice about when they first set up their books. It's the difference between cash and accrual accounting, and it matters more than most people think. So click right here, and I'm going to walk you through exactly what both of those methods mean and how to know which one is actually right for your business.